Here at Wealth Gambit, you know we love investing. Some of our all-time favorite investors are, of course, Warren Buffett and Charlie Munger. Warren Buffett is known as the greatest of all time when it comes to investing, or the GOAT for short. If you don't believe me, look at this photo. Now the question is, if we all learn from Warren Buffett, who did he learn from? The answer to that question is none other than Benjamin Graham, or the author of one of Warren Buffett's favorite investing books of all time, The Intelligent Investor. I know we say a lot of degenerate things on here on this channel, but we're actually disciples of Buffett, and through Warren we were introduced to Benjamin Graham. Now the book The Intelligent Investor on Audible is actually 17 hours and 48 minutes long, but just for being a Wealth Gambit subscriber and liking this video, we're dropping our top 10 points from reading the book that all investors should know, whether you're a veteran in the market or just getting into the markets. If you're new to our channel, hello and welcome to Wealth Gambit. On this channel we cover the latest stock trends and research. If you like that type of content, be sure to like and subscribe so you're updated as soon as we drop new videos. Also, make sure to follow us on social media at Wealth Gambit for stock market updates and some dank financial memes. Please note that we're not financial advisors and none of this is financial advice, so please always do your own due diligence. Shout out to SoFi God for showing love in the comment section. Thanks for watching and commenting on our videos. We appreciate it. Without further ado, let's get right into it. In this video, we'll go over our top 10 rules of investing that we got from the grandfather of investment himself, Benjamin Graham, in his book, The Intelligent Investor. Number 1. Margin of safety as the central concept of investing. Now I know what you're thinking. I already use margin. No, not that margin. According to Graham, the key idea to sound investment is buying undervalued stocks. Buying at a discounted price, even without the guarantee of price increase tomorrow, also guarantees that an investor's loss, if any, will be minimal. And when Graham says undervalued, he says buying a stock for 50 cents when its real value is $1. According to Graham, undervalued stocks are often driven to their low prices due to fear. Or oftentimes, investors will overreact to a problem in the business that is either temporary in nature or easy to fix. This overreaction can temporarily shoot a stock's price down into undervalued territory. Number 2, diversification correlates with margin of safety. Even when an intelligent investor's core investment principles revolve around the margin of safety, it only guarantees a better chance of profit than for loss. Not that loss is impossible, but if you diversify your resources with the margin of safety as one of the essential factors for each investment, then it's more likely that your aggregate profits will exceed your aggregate losses. This is specifically important if you're just starting out, because more than likely your first picks may not be the greatest, and so you need to protect yourself from yourself. Number 3. High risk doesn't necessarily mean high reward. Ben Graham talks a lot about risk versus reward and argues that higher risk doesn't necessarily mean higher reward. In fact, there are many instances where a stock could be high risk, very low reward, which we'll go over in a bit. Now this makes sense because a lot of the times the market is very irrational, from overpricing things to underpricing others. For example, let's take a look at Nikola, which at its peak had a market cap of about $21 to $23 billion. Definitely not a cheap valuation, but how much was the company actually generating in revenue to justify paying $21 to $23 billion for? The answer, according to businessinsider.com, zero. This right here is a perfect example of extremely high risk, super low reward. This also works in the opposite direction, according to Graham, and due to the market's crazy swings, you could sometimes find incredible companies for pennies on the dollar. Number 4, market fluctuations, focusing on what is under your control. This one is for those of you who have been sweating bullets lately during these dips. Benny G, aka Ben Graham, says there are 2 ways of dodging market fluctuations, either by way of timing or by way of pricing. Now what does he mean by this? The real intelligent investor doesn't just dodge, he or she dives at the opportunities when they pop up. And to do that, you need to be ready financially and, more importantly, mentally. Benny G says, if you want to speculate, do so with your eyes open, knowing that you will probably lose money in the end. Be sure to limit the amount at risk and to separate it completely from your investment program. Now, focusing on timing and pricing. Benny G highlights the buy low and sell high approach that's very popular even up to this day. Ben Graham says that we just have to make sure that we don't pay too much when buying. To do this, you need to focus on yourself and your emotions and look at things objectively. Don't get FOMO'd into things by others, and don't get FOMO'd out of good things just because the price went down. So, in a nutshell, Being an intelligent investor is about controlling the controllable. No one, no matter how hard they try and control the market. What you can control is your emotions, what you buy, and how much you pay for it. For those of you who want extra credit, here are some other things within your control: brokerage, ownership costs, expectations, risk, tax bills, aka long-term capital gains versus short-term capital gains, whether or not you live in a state that requires you to pay high income tax, California, and most importantly, your own behavior when investing. Number 5, you are likely to lose money when you speculate. Intelligent investors don't think of the stock market as a get-rich-quick scheme. Warren Buffett didn't become one of the OGs of investing overnight, but some investors see the stock market as a get-rich-quick scheme, and they do this by speculating. Even worse than that, some investors think they're investing when they're really just gambling. Number 6, what makes a company worth 10x earnings? 20x? 5 things to keep in mind. The stock isn't going to earn on its own without the company's executive management. And this is what you have to consider: the management's long-term prospects, the management itself, and the last 3, which we're going to mention in a bit. Warren Buffett and Ben Graham have a saying: price is what you pay, value is what you get. Evaluating how much you pay and what you actually get for what you pay is key. Now, instead of companies, let's look at Snow White's apple. Beautiful on the outside, but completely rotten on the inside. Let's talk about one that borrows debt or simply sells stocks. Take a company named Sycamore Networks Inc., for example, during October 1999. It's a fiber optics maker that went public just around that time, and the prospectus said one massive client named Williams Communications was the sole moneymaker of the company that gave them $11 million in revenue. Traders and investors who were a little too excited piled into the stock, and as a result, Sycamore's valuation increased all the way up to the $15 billion mark, only to find out that this big-time client faced bankruptcy 2 years after. Something was really off about this company that wasn't taken into account, and this is what's important to consider if you're going long on a stock. Is the management putting all their blood, sweat, and tears into making the company grow, or are they just wasting its potential? Number 7, do not skip the financial statements. One of the craziest things we've seen recently is how many people are willing to plow thousands, if not tens of thousands of dollars into a stock without even looking at the income statement or balance sheet of the company they're investing in, if you can even call that investing. If people spent half as much time looking into the financials of their investments as they do planning their Coachella trip, they'd be in definitely better shape. Aside from what's mentioned about the company in general, an intelligent investor must also be on guard against what's not obviously shown in the financial statements. Benny G laid down 2 pieces of advice, especially when you're looking at the per share earnings. First up, short-term earnings don't tell you much about the stock. Second, find some loopholes in the per share figures. Just some expert tips from great grandpa Benjamin: read the financial reports backwards, read the footnotes, and read more. There you could see if the company generates more cash than it consumes. If this sounds like a lot of work, it's because it is. If you don't want to do this, consider looking into an index fund like the good old S&P 500. Number 8, what you need to know about investment funds and how to beat them. For at least a half century, studies that zoomed in on the questionability of returns from investment funds have found that an average fund doesn't pick stocks well enough to outweigh the cost of researching and trading them. Second, you should look out for a fund's expenses, because the higher the expense, the lower its returns. And lastly, when you see that a fund trades its stocks faster than Eminem rapping on stage, stay away, far, far away. So when should you sell a fund? Here are some key red flags you must observe. When there's a significant change of strategy, increase in expenses, huge tax bills to pay from excessive trading, and of course, huge losses. Number 9, seeking help from advisors. Here in the next point, Ben Graham gives us some of his wisdom when selecting advisors, especially when you have huge losses piling up in your portfolio. Investment is about making money, and when you don't know how, or just don't want to have to deal with it yourself, you trust someone else to do so. But let's not forget, it's always about due diligence when handling investments. So Benjamin said, investors need to look for well-established and recommended firms. The goal is to make money, not lose it. If you don't want to do due diligence on where to invest your money, you better make sure to do due diligence on who you hire to invest your money. Number 10, investigate, then invest. An intelligent investor always does his own due diligence before investing, and that's because intelligent investors have a common mindset. They are in the stock market to gain money, to increase their wealth, so extensive research is put at hand before they put their money in any stock. And with that, we'll leave you with Grandpa Buffett and his thoughts on his legendary teacher and mentor, Benjamin Graham.
I read the book, but I had no idea those guys were teaching, so I wrote Dave Dodd, who was an associate dean, and I said, Dear Dean Dodd, this was in August, I said, I know this is a little late, but I said, I thought you guys were dead. And I said, now that I know you're alive, I would love to come back and study under you. And I got a letter back from him right away, and he said, you're admitted. So that was middle of August or so, and I went back there, and here I had my two heroes teaching, and that was the reason I ended up at Columbia. Ben was this incredible teacher. I mean, he was a natural, and I've done some teaching later on. I've actually tried to pattern some of the methods I use after what Ben did. He had a lot of ways of making points in a very that were memorable, just because of his style. It was clear that he enjoyed teaching.
That's it for today's video, guys. Which rule did you find the most helpful? As always, comment due diligence in the comments below so we know who watched till the end, so you can get shouted out in the next video. We'd love to know some of your rules of investing in the comment section below. Until next time, peace.